and welcome to this evening's Segregated Funds and Annuities Module Exam Prep Bootcamp. My name is Sam Albanese, and I'm going to be your instructor for this session. As always, I always recommend that you have pencil, paper, whatever, to write things down so that as things come up, obviously we can't answer all the questions as they go along. And of course, you may think of things after the session and everything. You're always welcome to email us. You can go to your website and you'll see the email address there, and you can email us and we'll be happy to hear from you. And we promise that we try to get back to you within that 24 to 48 hour period of time. The second funds is the one that usually gives people some difficulty. So I strongly urge you to be very close attention. And of course, don't forget that we also have the tape webinars that you can always go to for a review and everything else. Okay, so let's get ourselves started. So as always, of course, we review the content, in other words, the must-knows, basically, whatever concept. And of course, we'll answer any questions as we go along. But like I said, I can't answer them all. And of course, you'll think of things after that anyway, so you're always welcome to email us. So let's proceed. So the very first thing we have to look at when we talk about any kind of investments, of course, is this whole question, of course, of taxation, interest rates, things of that nature. Okay, that's always an issue when we talk about investments, investment products. So first thing we'll look at, obviously, is this whole question of capital gain. We always hear about these things, right? Capital gain, what is it? Well, basically, what happens is that you as an investor, for example, will put in your capital, or sometimes they call it the principal sum. So let's say you put in $100,000 or something into some kind of an investment, okay? And that investment, of course, will hopefully create some kind of a capital gain. In other words, the amount will increase. So as it says, increases which, of course, produce capital, or it could also decrease. In other words, you have a capital loss. So basically, because what you've got here is an investment, there is some risk involved. And so you can have a capital gain, you can have a capital loss, you can do any of those kind of things there. Of course, you can also buy investments that have guarantees. And those guarantees, of course, could also give you a minimum return and everything else. But remember that when we are investing in the market, for example, there are no guarantees. And that's why it says it can be some guaranteed income, but it can also be non-guaranteed income. So you have to be very careful when you're investing money depending on your particular risk tolerance and everything else. Okay, you may have a different risk tolerance. So some people can take more risks than others. That kind of stuff there. Ultimately, what we want, obviously, from any kind of investment, we want interest, dividends, or like I say, a capital gain. And so interest and dividends, of course, are payments that are made to you for the risk that you're taking. In other words, the return on your money. And once again, the return can be guaranteed or can be not guaranteed. In other words, it could fluctuate and everything. So I want to draw your attention to the yellow part of your screen there on the right side of the screen, which is what we call nominal return and real return. This is a very important concept. Nominal return basically is the return that you get essentially when you invest the money. In other words, what they call the posted rate. So sometimes, the bank will say, well, we give you 5% of your money, that kind of stuff there. That's nominal return. However, inflation, unfortunately, erodes the purchasing power. So many times what happens is the client wants to know, after inflation, what is my real rate of return? In other words, I want to know how much am I going to be able, what is my purchasing power? In other words, the future purchasing power. So the real rate of return formula is the nominal rate minus the inflation divided by 1 plus the inflation. And so basically that is a very important formula. So the nominal rate minus inflation, 1 plus inflation. Now, quite honestly, for exam purposes, you don't have to go this far. Really, all you need to know is this one here. In other words, approximate real rate of return equals nominal return minus inflation. So, for example, if nominal return is 5% and inflation is running at 2%, then your real rate of return is 3%. Simple as that. Okay. If you actually use this formula, it would be 2.94, I think, or 2.96, something like that. So it's pretty close to 3%. So like I said, I wouldn't worry too much about this. Nice to know. For exam purposes, if you can remember this particular formula here, you'll be probably good enough anyway. So basically, it's nominal return I said in my example, 5% minus inflation rate is 2%. And so therefore, the real rate of return is after inflation return, basically. That's really what real return means. It's after inflation will be 3%. Now remember also, besides the fact that you can buy products that obviously have a higher return, but higher risk and all that stuff there, you can also buy guaranteed investments such as GICs and bonds, okay? So for those people that have a very high risk tolerance, they can buy non-guaranteed investments like stocks, bond mutual funds, and real estate. But for those people that have a very low risk tolerance, in other words, you don't want to lose any money, then your best bet is stay with the guaranteed investments such as GICs, bonds, things of that nature. But remember that here, because of the fact that there isn't much risk, that means there isn't also much of a return. As they always say, no pain, no gain, as they say. So you got to be, understanding of the fact that if you're not prepared to take any risk, then your return is going to be low. So the non-guaranteed investment stocks, mutual funds, real estate, of course, there is risk involved. There is risk involved. And again, stocks are much higher risk. Mutual funds a little bit lesser risk. Real estate a little bit lesser risk, but the risk nonetheless. So that's the choice that you really have when it comes to investment options and everything else. So very much depends on your risk tolerance. The other thing we have to look at is the match of compound interest. Okay, this is a very, very important formula. So you need to basically mark this off as something that you need to have access to. Okay, obviously, a compounding interest would be basically a return on your earnings. In other words, basically a reinvestment of your earnings. So investment returns earned on reinvestment returns. Okay, so that's how you get the compound interest. So to maximize compound, all investment returns must be reinvested. So to give an example, if at the end of the year you had $1,000, let's say you invested, at the end of the year you had $100 worth of interest. If you took out that $100, the following year you're just going to get another 100. That's it. But if you kept the $100 in there December 31st, January 1st comes along, and now you have $1,100, you see, to invest. So in other words, the interest of December 31st becomes principal, you might say, or capital in January the 1st. So that's how compound interest actually works. So the formula, basically, for you to remember in terms of how does compound work is the amount of money that you invested equals the principal, 1 plus I being the interest rate, and N is the number of years that it's going to compound. So I'm going to give you an example here. If the sum of $1,000 is invested at a compound interest rate of 5% for 5 years, the amount the investor will have at the end of the 5 years is, so the amount equals $1,000, which is your investment, 1 plus 0.05, in other words, 1 plus the 5%, to the power of 5. Now, this is where I want to stop for a moment and just explain what's inside this bracket. It is not 5 times 1.05. That's wrong. It is 5 times basically 1.05 multiplied by itself. In other words, it's 1.05 times 1.05 times 1.05 times 1.05 times 1.05, 5 times. So it's not 5 times 1.05, but basically 1.05 multiplied by itself 5 times. And so that way you get 1.276. If you multiply 5 times 1.05, you're not going to get 1.276. Simple as that. So that's very important to remember that what's in the bracket, according to the basically the periods, that's what they call here. The 5 is the number of years or periods. Okay, this part here is multiplied by itself. So when you multiply that by itself 5 times, then it's 1.275. So today, if you gave me $1,000 and I invested it at 5% compound interest for 5 years, 5 years from now, I will give you a check for $1,276. That's basically the matching compound interest. So I strongly recommend that you make a reference to that particular chart because you will definitely get a question on the exam in this particular area. 2 more formulas that you need to know. These are very, very, very important formulas. Okay, time value of money. And so the definition of time value of money basically is that $1 today is worth more than $1 tomorrow. That's the basic definition of time value of money, that $1 today is worth more than $1 tomorrow. And the idea behind this, of course, that inflation, of course, erodes the purchasing power. That's why $1 today buys more than $1 tomorrow, because $1 tomorrow, because of inflation, of course, will buy you less. Okay, So having said all that, you have two formulas. The first formula, which is on the pink side here, is future value. In other words, how much am I going to get at the other end if I gave you a certain amount of money? So you're looking for future value. So the present value is the amount of money that you're going to invest today. That's why they say it's present value. I, of course, is the interest rate, and N, once again, is the number of years. So you look at the example. So here I am, Sam has $5,000 today, and he wants to know the value of that sum in 5 years, given the current annual rate of return of 3%. So the future value of $5,000 in 5 years' time at 3% annual interest rate is. So here is basically the formula. Future value equals present value, which is your $5,000, okay, times 1 plus 0.03. So once again, with a 1.03 is multiplied by itself 5 times. So 1.03 times 0.143 times 1.03. And when you multiply that out, whatever that number comes out to be, you multiply that by 5,000, and you get $5,796. So that's a very important formula. So because your client is basically going to say, okay, if I gave you this much money, how much are you going to give me at the other end? So it very much depends on two factors: time, which is, of course, is in this case 5 years, and of course the interest rate, which in this case is 3%. Okay? And so the future value of $5,000 invested at 3% is $5,706.37. Okay? Sometimes, however, the client says, I would like to have a certain amount of money in the future. I want to know what is my future value. So in other words, I know what my present value is, but what I don't know is my future value. So if I have a specific amount of money that I would like to have in the future, how much money do I have to give you today in order to have that specific money in the future? So this is the exact opposite to the future value. In that this formula is a present value. So present value equals future value. Again, 1 plus I, R of N. Present value is PV, FV is future value, I is interest, N is number of years. So it's the exact same names and everything else. So here's an example. Julie wants to know how much is needed today, that's the word important, today, to provide $5,000 in 5 years, given the current annual interest rate of 3%. So the present value of $5,000 in 5 years based on 3% discounted rate of annual rate of return is, once again, the formula is present value, 5,000 divided by 1 plus I, so it was 1 plus 0.03, once again, 1.03 times 1.03 times 1.03, 5 times basically, okay? And so you do that. So basically in our example, if you gave me $4,313, and I invested that at 3% for a period of 5 years, at the end of 5 years, I will give you a check for $5,000. So this formula is very useful when a client of yours has a very specific number in mind that they would like to have. Okay, so they say, I want to have, $100,000 by the time I'm 60 years old, and I'm 50 right now. How much money do I have to invest right now at a certain rate of interest in order to have $100,000 at age 65? So the present value formula is very, very useful when you want to figure out how much money is needed or how much money a person wants in a future date and how much money they have to invest today. So these two formulas are very, very important. So I strongly recommend put a little sticker next to this basically to remind you, because you will definitely have questions on the exam on both. These are the core investment formulas basically that you need to know. So you got 3 formulas basically: the compound interest one, which is P equals 1 plus I, the power of whatever, the future value formula, and of course the present value formula. So you must know those 3 formulas, or at the very least tag them so that you can refer to them on an as needed basis during the exam period. Now, with any investments, of course, there's always risk. Okay, as much as we try to minimize the risk and everything else, you do have some degree of risk. So let's take a look at some of these investments first of all. Okay, so let's take a look at type of investment. So if you invest your money into GICs or GIAs, in other words, guaranteed investment accounts, all that. So in other words, guarantees. Obviously, the risk is very low, but still there's risk. And the biggest risk you have are guaranteed interest rate risk and inflation risk. Remember that inflation erodes the purchasing power. So if you had $5,000 today and it buys $5,000 worth of goods today at a certain rate of inflation, obviously, 10 years from now, you may only buy $4,000 worth of goods. So there is the risk of inflation. Also, interest rate risk. If right now you're getting, let's say, 5% on your money, but when the GIC renews 3 years from now, whatever, let's say the interest rates were lower than 5%, go down to 3%, then you've obviously lost 2% on that money. And so there is, so on the exam, they are going to say to you, what are the two biggest risks for guaranteed type of products? And the two biggest risks for guaranteed products is, of course, interest rate risk and inflation risk. Now, because they are guarantees, there is a degree of protection that in the event of the company failing for whatever reason, you do have the Canada Deposit Insurance Corporation, CDIC. So any of you have your bank accounts and everything else, up to $100,000 in your bank account is protected against default, basically. So the CDIC, or Canadian Deposit Insurance Corporation, protects that, but no more than $100,000. The next investment is money markets. That is basically treasury bills, bankers' acceptance, things of that nature there. Okay? Those again, very highly guaranteed products. So once again, they have the same problem. You have interest rate risk and inflation risk. There is no CDIC, however, on money market funds. Okay, so you're basically totally exposed in the event that the organization that you bought your treasury bills from goes belly up. Basically, you're not protected under CDIC or anything. The next one is fixed income security. So this is where you get into your bonds, things of that nature. Okay, so fixed income is interest rate risk. Bonds is reinvestment risk. Okay, equities and credit risk, liquidity risk, inflation risk. In other words, these particular kinds of investments do carry a much higher risk factor, and so there is interest rate risk. There's also reinvestment risk in that you were hoping you were going to get 5% forever and a day, but when in fact you did reinvest it, you only got 3%. So this is a reinvestment risk. Credit risk, if the company goes belly up and creditors now are chasing after the money, the creditors, they're secured creditors, are the ones that actually get the first crack. So you're not going to get your hands on your money. You may be the last person on the totem pole, basically. Liquidity risk, in that you may not be able to cash these particular bonds or whatever is before the maturity date. And of course, because there is some guarantees, of course, you have inflation risk as well. Now, in the event that the company should fail, of course, the protection you have is what they call the protection of the Canadian Investor Protection Fund, CIPF. And that covers you up to $1 million. If the firm that you've got your money invested with goes belly up, you have the CIPF, and that is up to $1 million worth of protection. And the last one, which is the highest risk, of course, is the equity market. In other words, the stock market, basically. So here, the risk, of course, you can lose everything. Okay, you can lose everything. And believe me, there have been many people that have lost everything. Essentially, okay. If any of you remember 2008, 2009, the stock market tanked considerably, and a lot of people lost all their money or 50% of their money or whatever. So it is a very high risk type of thing. Okay. You also have commissions that have to be paid. You have liquidity risk. You may not be able to sell those shares because nobody wants them, and so if you can't sell them, they're useless, basically. Okay. And of course, there's no rescission right. In other words, you can't change your mind. You can't turn around and say, okay, here's my money. Oh, by the way, like a day later, 2 days later, you change your mind and you want your money back. It doesn't work that way. You can get your money back, but if it's still the same value. But if the value has dropped during that period of time, you're going to get the dropped value essentially. And once again, if the organization that you're using, your stockbroker, in other words, goes belly up, then it's also protected under CIPF. So you can see that regardless of the investments, there is some degree of risk. You really can't get away from that kind of thing there. Okay, and so the issue really is how much risk are you prepared to take? So if you are not prepared to take any risk, then you better stick with GICs or GIAs or whatever. But you're not going to earn very much. If on the other hand, you're prepared to take some risk, you may want to go the other way and buy equities like say the stock market and everything else. But that is, of course, much more volatile type of things. You got to be careful about. In other words, don't spend your mortgage money on equities. Basically, be very careful with your grocery money. Stuff like that. Okay, so let's take a look now at the fixed income investments. These are basically the most safest. Like I said, there's always risk, okay? But they are the safest kind of investments. So the first thing we look at, and this is primarily bonds, annuities, things of that nature there, okay? So the par value is the base value. In other words, what you bought the bond for. So let's say you bought a $10,000 bond. That is the par value, $10,000, or face value, $10,000. Okay? Many bonds, of course, will pay you a coupon. There's a coupons, and they're exactly that. They're real coupons basically attached to the bond, which you can sort of strip off, you might say, go to the bank and cash that the coupon without affecting your bond. In other words, that $10,000 bond may have a 5% coupon rate. So it's $500 coupon rate. You don't want to touch the bond. You want to just have your $500, let's say. So therefore, you go to the bank with that coupon, and they will give you the $500. And so the 5% is what we refer to as a coupon rate. So it's a 5% coupon rate. Term to maturity is when the bond actually matures. And so therefore, it could be, for example, 5% term to maturity. So at the 10th year, let's say that the bond was a $10,000 10-year bond. So what you've got is a term to maturity of 10 years. Okay, so that's what you've got. Yield to maturity is how much money you're going to get at the other end. So you'll get your $10,000, of course, but you're also going to get the interest. If you haven't cashed it in prior to that, you're going to get the interest that it's actually gained and everything. And so that's what they call the yield to maturity, is what is my yield? So my $10,000 has now grown to 10,500, let's say, and my yield to maturity is 10,500 because I have actually more money than at the end that I started off with. So yield to maturity is how much am I going to get at the other end. Most bonds will have a par value of $100 and then multiples of that. Okay, so you buy one bond, for example, $100, but you may buy $10,000, which means basically that you bought 1,000 bonds, you might say, at $100 each. But let's say it was all $100 just to keep it simple. So if you buy a bond for less than $100, so for example, they're $97, that means you bought the bond at a discounted rate. So even though it's a $100 bond, and at the end of 10 years, let's say it was a 10-year bond, you're going to get $100, but you only bought it for $97. So therefore, your yield to maturity is, in actual fact, $3 for every 100. So because you're getting more money than you actually paid for it. So you bought the bond at a discounted rate. However, if you bought the bond for a higher rate, in other words, you paid more for them above the $100, let's say you bought it at $103, then you bought it at a premium. Okay, you bought it at a premium. So if you bought it less than the par value, you bought the bond at a discounted rate. If you bought the bond for a higher rate than the par value, then you bought the bond at a premium rate. That's really all you need to know for this particular situation. One of the strange things about bonds that people still get confused about, and I can certainly appreciate it, basically is what happens with interest rates go up and when interest rates go down in regards to bonds. So basically, as the chart says, if you look at the right side, if the interest rates go up, so the green area is going up, okay, the bond prices go down. So that gives you a higher yield, basically. So if interest rates go up, the bond prices go down, and that gives you a higher yield to maturity. On the other hand, yield to maturity is par less discount? No. The question on the is yield to maturity par less the discount? Yield to maturity basically is what did you buy the bond for? So in this case here, let's say you did buy it for a discounted rate of $97. Okay, but at the other end, when you did sell it, the 10th year, let's say, it was $100 because remember it was par. So the first thing is you got your $3 back, you might say, because it's $100. And on top of that, you also had a 5% interest rate. Let's say you got an additional $5. Let's say so your yield maturity is $5 plus the $3 that you made from the $97. So yield to maturity is actually $8 is what you made on that because you bought it at a discounted rate. Okay, so that's really what we're saying, and that's why it's not the yield to maturity is always what did you buy the bond for. So you could have bought it at a discount, you could have bought it at a premium, and so but at the end when you finally sold it, what did you sell it for? So the difference what you bought and what you sold is referred to as the yield to maturity. Okay, hope that clarifies that. So going back to our question here, okay, thank you. So the bond price, so if interest rates go up, the bond price goes down and the yields go up. If the interest rates go down, the bond prices go up and the yield obviously goes down. In other words, the bond prices increase in value, so they're basically more expensive. I know that basically the best way to remember this bond thing is if interest rates go up, the bond value drops. If interest rates go down, the bond value increases. It's a teeter-totter type of so it's what they call inverted correlation. So they're not correlated, they're inverted correlated basically. I know it gets a little bit hairy and all that, but best I can do with the time that we've got right now. Okay, so when you invest money, basically you're buying a portfolio, let's say, various different investments that you have. So if you look at the pink side of here, you can have a portfolio of assets, and in that portfolio, there's all kinds of stuff that you can have. You can have common shares, preferred shares, money market, GSCs, mortgages, bonds. Regardless of what your portfolio is, okay, there's only three kinds of income that any portfolio will produce. It does not produce any other kind of income. You can either get interest, dividends, or capital gains. Those are the only three different kinds of income that you can get from your portfolio. So depending on the mixture of your portfolio, it may be very heavy in interest and very little on dividends and capital gains. On the other hand, if you end up putting a lot of money into preferred shares, for example, it'll be very, very high on dividends, very low on interest. On the other hand, if you put all your money into common shares, you can be very, very high in capital gains, maybe very little in dividends, and very little in interest. Okay, so depending on the portfolio mixture, basically, you will then get only three kinds of income. So once again, depending on your risk tolerance, you can decide, how do I want to invest my money? And so if you're interested more in a very high interest return, then you tend to buy more like bonds, GICs, mortgages, things of that nature there. If you are interested more in terms of getting a high dividend, preferred shares are usually your best bet for that kind of thing. But if you're looking at capital gains, then obviously common shares would be your best bet. So you can mix and match your portfolio based on your tolerance, what you want to do, and what kind of income that you want to get at the other end. Now, a big chunk of your decision, of course, will depend on your tax bracket. So if you're in a very low tax bracket, it may be just fine. Okay? If you're in a very high tax bracket, you might want to have capital gains, because capital gains are tax favored. Dividends are also tax favored. Interest rates are not tax favored. So you see, a lot when your decision making also has a great deal to do with the tax bracket that you actually happen to be in. So high tax bracket people, in other words, people that are earning six-figure income or more, they tend to invest their money into dividend-driven products, capital gain-driven products. Okay? People in the lower end, people that are earning $25,000, $30,000, that kind of stuff there, they tend to go more towards interest because you can't take remember that these here is much higher risk here. There's really no risk here whatsoever. Okay? These ones here, of course, have a much higher risk, and so you've got to be very careful with all that. Okay? Let's go on. So, having said all that, what happens in our industry, and I can only speak to our industry, obviously, okay, is that we sell segregated funds. Okay, we sell segregated funds. So the end result is that a segregated fund is actually an insurance company mutual fund. It's really the same type of thing, except that in order for you to sell a mutual fund, you have to have a securities license. So if you don't have a securities license, you can't sell a mutual fund. Simple as that. However, a life insurance license, which is of course what you guys are working for right now, you can sell segregated funds, which are extremely similar to the mutual funds. However, there are some differences because segregated funds are the insurance companies' mutual funds, essentially. Okay, so there are going to be some differences. Okay, so let's take a look at some of those differences. So first of all, look at the similarities. In both cases, okay, there are going to be fees. Okay, everybody has to get paid, obviously. So whether you buy a mutual fund or whether you buy a segregated fund, there's going to be fees, and those fees are basically, your MERs, okay, your management expense ratios, basically, are those fees. Okay. There's also commissions on your sales. Obviously, you want to get paid. The commission could be front-end loaded, which I'll explain in a moment, or a deferred sale charge, which again, I'll explain in a moment. So let's take a look at the front end first of all. So the guy says, look, I want to give you my $10,000. That's what I want to give you. And the unit price for each share, let's say, or a unit is $10, okay? And the front end commission is 4%. That means that if you gave me $10,000 and I get $400 for my troubles, me being the agent, okay? Then really all you're doing is investing $9,600. You're not investing $10,000. So all your salesperson, your investor can actually invest $9,600. So in other words, you can only buy 960 units. Okay? So assume that the unit price is $15 at the other end. In other words, when you cash in, it's gone from $10 to $15, so you made $5 per share. So how much money are you going to get at the redemption time? In other words, at the end of that period, and it'll be 960 units, which is what you bought, right? Times $15, you get a check for $14,400. That's basically what we're saying. You're going to get a check for $14,400, okay, for that. So front end load basically means that you pay all your expenses up front. So if at any time that you decide, let's say this was a 10-year investment, and you came back to me in the 5th year and you said, I want to cash out, you'll get whatever the value is, and that's it. There are no further charges on your investments. There's no further charges because you paid all your charges right up front. So therefore, because you had a front-end load, all future times when you cash out, there'll be no penalty whatsoever. And that's the beautiful thing about it, is that you've covered yourself right from the beginning, and that's the end of it. However, if you don't want the front-end load, in other words, I want all my money invested. I don't want anybody taking anything, put it in the pocket. I want all my money invested. Then you're asking for a deferred sales charge. A deferred sales charge. So once again, you invested $10,000. Unit price is $10, and you chose the deferred sales charge option. So therefore, you have 1,000 units. See, whereas before you only had 960 units because we took $400 away from you, basically. So once again, same assumption. Assume that the unit price is $15 of redemption. So the redemption of price now is 15 times $1,000. So therefore, your $15,000 is the amount of money, okay, that you took out. Okay? However, let's assume that you took out the money before the actual maturity date. So let's just say that you took it out before. What you've got to worry about is that what's going to happen is we're going to penalize you because you took out the money too soon. So if you look at the chart on the right side here, you'll see a table. So 1 to 2 years, for example, is 7 years charge. So in our situation, basically that 5% was taken out in between 3rd and 4th year, let's say. So you can see that because you didn't pay your fees up front, you decided to take the first sales charge. What we're going to do is we're going to charge you later on if you come to us before the maturity date. Remember that the maturity date is always 10 years. It's always 10 years. So if you came to us in the 7th year, there will be no sales charge. In other words, we're completely paid for. But if you came to us between the 2nd and 3rd year, I may charge you 5%. I may charge you 6%. That kind of thing there. So what you've got to be careful of is that you've got 2 ways. You can either pay all your fees up front, and therefore you don't have to worry about any future fees, Or you can say, no, I want all my money invested right up front, and I'll take my chances, and I may or may not need the money at the other end. But just be aware that if you do take out money before the maturity date, there could be a charge. Obviously, that charge will be a lower charge as the years go on. So like in the chart that you see on the right-hand side, from 7 years onwards, there'll be no charge whatsoever. But after the 6th year, there will be a charge. So you have to sort of factor that into the calculation that you could lose some money. So in this case here, the individual did have 15,000. However, because he took out the money before the 10 years, we charged him a 5% fee, and so therefore he lost $750, and so therefore all he's going to get out of this is $14,250 because he has to pay that penalty, you might say. Okay, so it's very important that you understand the difference between body and load, how the insurance company makes profit. If on the investments, it really the first 6 years. The question on the floor is how does the insurance company makes money if the person does after the 7th year? The first thing we look at is that the insurance company has recovered all of their costs in the first 6 years, basically, because you left the money there. So that's why they don't have a first sales charge after the 6th year, because we have recovered all of our costs. So the rest of it really is earnings on the investments, is essentially. So they make money, the insurance company makes money, you'll make money, that kind of stuff there. So the point is that once all the sales charges, once all the expenses have been taken care of, which is what the deferred sales charge is really all about, then the company will make money strictly on the investment. Hope that helps. Okay, let's go on. So who are the parties to the IVIC, okay, to the segregated fund, basically, okay? So let's take a look at some of the very unique features of a segregated fund that are not necessarily available on mutual funds, okay? So the first thing which we're going to look at is who are the parties to the contract. So the first one, of course, is the policy owner, okay? The policy owner, the contract holder, basically, is the person who makes the deal with the insurance company. So that has all the controls. The annuitant is the person who actually has the annuity itself. Okay, so the annuitant is the person who owns the actual proceeds. So if I am the policy holder of a $10,000 seg fund, and I'm also the annuitant, it's a personal seg fund. So therefore, I get the money. But remember, I could also buy a seg fund on my spouse. I can buy a seg fund on my children. In that case, I'm the owner, but my children are the annuitant, so my spouse is the annuitant. And they get the money in the event that they cash the policy in, you see. So it's very similar to what we talked about life insurance. This is essentially, personal insurance and third-party insurance, the same idea. So when the policy owner and the annuitant are the same, it's a personal annuity. When the policy owner and the annuitant are different, it's a third-party annuity. Same. So it's the same as life insurance. And of course, the beneficiary is the person who receives the proceeds in the event that the annuitant dies. So the beneficiary is the same as we have on life insurance. Okay, who gets the money if the annuitant actually dies? Okay. So some of the other very important features of IVIC, basically, and we're going to look at each one of these very carefully in a moment. Okay, maturity guarantee, death benefit guarantee, creditor protection, exemption from probate, and reset options. So let's take a look at those. These are, like I say, the blue part are the unique features of the segregated funds. So let's take a look at maturity guarantee first, which is the one that most people really like about and why people buy segregated funds. By law, anybody selling segregated funds in Canada must guarantee 75% of the principal, okay, at maturity. Maturity is always 10 years. And so therefore, what I'm saying is that from an investment perspective, you're only risking 25% of your money. You're not risking the total amount. If you took the $10,000 and you put it into a mutual fund, and 10 years from now it's only worth $1,000, you get $1,000, and that's it. But if you took that same $10,000, you bought it in the seg fund, and 10 years from now you tanked $1,000, you're going to get $7,500. You see, because the guarantee is 75% of your deposit, basically. So that's the minimum guarantee on maturity, not before. On maturity, the minimum guarantee is 75% of your deposit, principal deposit. So let's take an example here. We've got an individual who's going to give us $100,000 on April the 1st, 2010. And it's going to mature April the 1st, 2020. Okay, so 10 years down the line. So the guarantee is 75%. So a worst case scenario, no matter what happens to the market, okay, the worst case scenario is you're going to get $75,000. That's your bottom line. So in other words, your stop loss is $75,000, basically. Okay. Obviously, if you make more, you're going to get more. But if it's less, you're going to get the $75,000. Okay. So the maturity guarantee in this case here, because at April the 20th, you have $180,000. That, in other words, you will receive $180,000. The maturity guarantee is 0. So this is where some confusion lies. If the amount of money at maturity is greater than 75%, then the maturity guarantee will be 0. On the exam, they're going to ask you a question exactly like that. What if the amount of money is greater than 75%? Then the maturity guarantee is 0. Because why would you take $75,000 when in fact you've got $180,000? So if you have any more money than the 75%, then the maturity guarantee will be 0 because you're going to get the greater amount, not the lesser amount. Why would you take the lesser amount? You're going to take the greater amount. Okay? So that's a very important thing to remember, is that in the calculation, if the amount of money at maturity is greater than the guarantee, then the maturity guarantee will be 0, okay? Because you're going to get the greater amount. On the other hand, what if it's the other way around? Okay? So once again, you gave me $100,000 and all that, but April 1st, 2020, it rolls along, and your $100,000 now only worth $60,000. Okay? Well, the maturity guarantee is $75,000, right? Because it's less. It's less than the 75%. And so the insurance company has to top it up by $15,000. So if it's more than 75%, the maturity guarantee is 0. If the amount of money at maturity is less than the maturity guarantee, then you have to calculate what the maturity guarantee is. In this case, of course, $75,000, and the insurance company has to top it up by $15,000. Okay, so you must know these two concepts. This is fundamental to the segregated funds. So this is an area where you will definitely get a question on the exam. You're going to get probably 2 questions. One of them will be greater, which means that the maturity guarantee will be 0, or the other question will be that the amount of money will be less than the maturity guarantee, which means now you have to calculate the maturity guarantee, which in this case, of course, $75,000, and the insurance company has to top it up by $15,000. And so their maturity guarantee is $75,000. Okay. So hopefully I explained that well, because like I said, you will definitely have a question on the exam on these 2 slides for sure. There's also a surrender value. What if you didn't want to wait until 2020? In other words, somewhere in between, so halfway through, you decide, you know what, I'm going to cash it in. In that case, then the maturity guarantee does not fit in. Whatever the value is in between that 10 years, so in this example, it was $60,000, then you're going to get $60,000. In other words, the only time you get the guarantee is on the maturity date, period. So if you cashed it in before that, you get whatever the value is that particular day, and that's it. So in this example, $60,000, that's what you get. That's it. So the maturity guarantee has to be strictly at the maturity date. In other words, 10 years from the date of deposit. That's all you have to remember. Anything less than that, you're just going to get the market value. Okay. So the other guarantee, of course, is the death benefit guarantee. Okay, the death benefit guarantee. And here, once again, by law, every insurance company that sells segregated funds must give you a 75% death benefit guarantee. So if you died within that 10 years, a worst case scenario is you're going to get 75% of your deposit. So we go back once again to the example. You gave me $100,000 April the 1st, 2010. And midway, basically, the annuitant dies and there was $60,000 involved. Well, the beneficiary will receive $75,000 because the death benefit guarantee is $75,000 and the insurance company has to top it up by $15,000. Okay, so that's the beautiful thing about this. So in the previous slide, I said if you cashed it in, you're only going to get $6,000. In this slide, I'm saying if you died, you're going to get the death benefit guarantee. And the death benefit guarantee is $75,000. So the fact that there is only $60,000, that means the insurance company has to top it up by $15,000. In other words, the death benefit guarantee holds only on the death of the annuitant, not the owner, but the annuitant, the person who actually we are investing the money with. Okay, and so therefore, segregated funds provide an excellent protection against dying prematurely, as well as living to the maturity date, and in which case then you will get the maturity guarantee basically at in this case here 75%. So read the question very carefully on the exam, because sometimes also you may have 100% guarantee, in which case everything I've said here will be 100% instead of 75%, but it's the exact same principle. It's the exact same principle. Okay, so those are two very, very important concepts, and in regards to unique features of the segregated funds that are not available on mutual funds. The other very, very good option is resets. This is a little more complicated. What we're saying is that let's assume you gave me in 2010, you gave me that 100,000, and again 75% guarantee and all that sort of stuff there. And then 5 years later, you get a statement from the insurance company, and the insurance company says, well, you doubled your money, you've done very, very well. Now what you do is you reset, okay, you reset the market. In other words, you lock in your gains. You don't want to lose that $200,000. At the same time, you don't want to cash it in either. And so therefore, you say, all right, can I lock in my gains? And the answer is yes, you can lock in your gains by reset. So you can reset. Some companies will allow you to reset once a year, 2 times a year, all that sort of stuff there. So therefore, now this is where it becomes interesting. The guarantee is no longer based on the 100,000. The guarantee will be based on the 200,000. In other words, the reset number. And that's the beauty of it, is that the guarantee will now be based on the reset. So 75% of 200,000 is $150,000. So on maturity, a worst case scenario here, you're going to get $150,000. If you died, a worst case scenario is you're going to get $150,000 basically. Okay? However, if I'm going to give you something, the insurance company is going to give you something that will allow you to reset, they want something in return. And that is something in return is that the maturity date is now 2025. Okay, 2025. In other words, we have extended it now. So when you reset, you're pushing the maturity date down 10 years. So you reset October 2015, and therefore you will then, the maturity date will be October 2025. So that's the downside, you might say, in that if you wanted your money before that, it may cause a problem. In other words, if you wanted your money exactly 10 years from the first deposit, 2020, but you reset it, then you're in between cycles. And so therefore, it will be according to whatever the value is at the time that you cash your money in, basically. So we don't give you any guarantees. The death benefit guarantee is certainly there, but not the living benefit guarantee. But if you wait until the maturity date, then you will get 75% of the reset. So again, you're going to get a question on the exam on resets. So it's a very important concept. So you're going to get a question on death benefit, maturity, and reset, absolutely for sure. So you must make sure that you understand how that part actually works. Okay. So segregated funds, okay, basically the principle of segregated funds essentially is that you're allowed certain privileges, and it falls under certain types of regulatory affairs and everything else. So let's take a look at some of these things here, okay, on recommendations basically. You can make switches. When you buy a segregated fund, you can switch from one fund to another. So it's not that, okay, I bought this fund and I'm stuck with this fund forever and a day or something. No, that's not true. Basically, you can make switches. But in the process of switches, two things you got to be careful of is that some companies may charge you a fee for those switches. Some companies don't. So again, you got to be careful. So there could be a fee between funds if you switch, and also there could be some taxation issues because you see, we might have had to sell one fund in order to buy another fund. So in the process of selling one fund, it might throw up a gain, in which case then of course you have to report that gain as for income tax purchases. So two things you got to be careful about when you're switching. That is this whole question of fees that you could be charged, and of course taxation that could be triggered by switching these. But again, take a look at the company you're doing your segregated funds with to make sure that you understand the full benefits of all of this. Okay. The other thing that we always suggest is, of course, it's your job to make certain recommendations. So in other words, you must do what's called a risk tolerance test for your client. And that way you can recommend. So for example, if the person has a very low risk tolerance, so they can't afford to lose any money, then the last thing you want to do is put the money into equities, because that's very high risk. Okay, stock market, international funds, things of that nature. So you may want to stay close to home and buy bonds, buy GICs, things of that nature. If the person is in the middle of the road, in other words, they're medium risk, you may want to put some money in GICs, bonds, and then put some money into equities. If the person, on the other hand, is a high roller, you might say, and quite used to making money and losing money and all that, you can put the money, of course, international funds, equities, oil, which is very volatile, as we know, minerals, things of that nature there. So once again, what you've got to do is you've got to make your recommendation to your client in terms of their risk tolerance. Okay? Segregated funds can be purchased on a non-registered basis and can also be purchased on a registered basis. Okay, in other words, RSPs, things of that nature there. Okay? When you buy a segregated fund, you must comply with that horrible PCML or GFA. What that is money laundering. Okay, that's it. It's proceeds of crime and money laundering, blah blah blah, and so on and so forth. Okay, whatever. Okay, transaction, financial affairs. Okay, so basically, what we're saying is that if you are buying a non-registered plan, if it's registered, you do not have to worry about the money laundering. In other words, registered money is they refer to as exempt. So you do not have to worry about reporting that to FINTRAC. But if a person comes in and buys a non-registered segregated fund, then for $10,000 or more, then it must be reported to FINTRAC. Now, normally what happens, of course, the insurance company does that for you. Okay? So, but if you do have a client that's going to give you more than $10,000 and it is non-registered money, then you must properly identify that individual. And you're going to see how we do that in a moment. Okay? You must report the suspicious transactions, so to speak, to FINTRAC. You must keep a record of any deposits that are made $10,000 or more over the lifetime of the contract. And also, you need to identify whether this individual is a PEFP. A PEFP is basically a politically exposed foreign person. Okay, politically exposed foreign person. So if, for example, the individual walks into your office and he buys $100,000 worth of segregated funds or annuities, non-registered member, not registered, you don't have to worry about it because they're exempt, but non-registered money, then you need to ascertain whether this person is a politically exposed foreign person. And so what you have to ask him is, was he ever in government? Was he ever the government? Was he ever a general? Was he ever a lawyer? Things of that nature there. Because as you know, unfortunately, corruption starts from the top. In other words, where did you get this money from, basically? Okay? So we need to ascertain if a person walks in with $100,000 or more, we need to ascertain whether, in fact, this individual is a politically exposed foreign person. And once again, if you suspect that he is, you need to report that to FINTRAC as well. How do we get the identity? So the following documents are used to establish the identity. A birth certificate. Now remember, in all these documents, it has to be the original. you can make a copy of it because you will verify or testify that you saw the original, okay? So an original birth certificate, an original driver's license, passport, record of landing, permanent residence card. These are all records, basically, original documents that are issued, of course, by government institutions to verify that this individual is a legitimate person, okay? And therefore, you need to be able, so if you do have suspicion this person may be involved in money laundering or is a politically exposed foreign person, and they're giving you $10,000 or more or $100,000 or more, then you need to have these documents. Okay, you need to have these documents, at least one of them, and that has to be filed with the application to the insurance company. That way, they can keep a record of all this stuff. Okay. So let's take a look at annuities. Okay, annuities. So an annuity basically means annual payment. That's really what an annuity is. It's an annual payment. And basically what happens is you've got a bag of money. You've got a bag of money, 100,000, 500,000, whatever it is. Okay. And now what you want to do is you want to basically invest that with an insurance company and to be able to get regular interval of payments. In other words, here's my $500,000, and I would like you, bank or insurance company, whatever it is, to pay me an income for the rest of my life, or whatever, that 20 years, whatever that period happens to be. And so an annuity is a system whereby very large sums of money are actually deposited with the financial institution. And in turn, the financial institution then gives you a paycheck every month, let's say, for whatever period of time, the rest of your life, 20 years, 5 years, whatever. Okay? So an annuity contract is an agreement with a financial institution or insurance company to provide the annuitant an annuity. The owner may or may not be the annuitant. In other words, I can buy an annuity on my son, on my spouse, whatever. So it doesn't have to be the same member, that third party annuity. The annuities are purchased with a big bag of money, based funds. Okay? So here what we've got is the present value is, of course, your money. That's the money you're giving us, okay? And then the interest is the green part. Okay, so that green part is the interest. So when the money gets paid out, so in other words, the payments are made, an annuity consists of two types of income. A return of your own money, which is, of course, this purple sign here, whatever, a return of your own money, and a return of the interest on in other words, the interest gain and everything. So really, an annuity consists of interest payment plus a return of your own money. A way to remember annuity is if any of you have a mortgage, what happens there is that mortgage, 25-year amortization, let's say, is actually an annuity for 25 years. Because what happens there is the bank gave you, let's say, $500,000 to go out and buy yourself a house. And you, in turn, are going to pay them a monthly amount of, let's say, $2,000 a month for the next 25 years. So you see, a mortgage is really an annuity. It's just that in that case, it's the bank that gave you the big bag of money to go out and buy a house, and you in turn said, okay, I will pay you $2,000 a month, which of course consists of principal and interest, right? And that's exactly what an annuity is. What the annuity payment to you is principal and interest. And so therefore the parties are the same. The policy holder, in other words, the contract holder, the annuitant, the person who actually invests the money, and of course, who are going to pay the money to. And in the event the annuitant dies, the beneficiary, of course, will receive balance of that money. So in its simplest form, when you're thinking of an annuity, think of a mortgage, and that should give you a trigger as to how annuity actually works. Now there are different kinds of annuities, and we need to take a look at those. Okay, so the two main arms of annuities is what we call immediate annuities and deferred annuities. So let's take a look at an immediate annuity. In an immediate annuity, yields the first payment 1 month after the purchase of the annuity, or within 1 year of the purchase. Okay, so in other words, here's my bag of money and my $500,000, and I want you to start sending me a check within 1 year. In other words, I want you to send me a check a month from now. That is a typical mortgage, right? So the bank gave you the money, and now 30 days later, you have to start giving them a check, right? Same idea. So an immediate annuity is really a mortgage, except that in this case here, the insurance company you have lent money to the insurance company, and the insurance company agrees to pay you a monthly income for, again, for the rest of your life or whatever period of time. A deferred annuity, on the other hand, commences after a year. So in other words, here's my bag of money, but hang on to the money until I'm ready for it, basically. In other words, after a year. So it could be a 10-year, it could be 20 years, whatever it is, okay? So basically, let's take a look at that deferred annuity for a moment. So you make that deposit. It is non-registered money, so it goes tax. You have to pay your tax as we go along, or it could be registered money, in which case then there is no accrual. So in other words, your RRSP is a deferred annuity. So during the time that you're putting your money in, it accumulates. So this is the accumulated amount. So in this case here, you're 45 years old, and at age 65, you say, okay, I'm not putting any more money in. Now I want you to start paying me out. In other words, a payout. And so therefore, once again, you're going to get interest and principal back for the rest of your life, or again, whatever period that you want. So a deferred annuity does not start making payments until after 1 year. So anything beyond a year is deferred annuity. Anything that starts within a year is called an immediate annuity. And again, both could be unregistered, or they could be registered annuities. It's all up to depending on the kind of income that you want. If you decide before the maturity date, let's say on a deferred annuity, you decide that you would like to cash out. In other words, I don't want to keep it to age 65 anymore. I want to cash out. You can certainly do so. However, that withdrawal could be subject to a substantial market value adjustment. Okay, it could be, in other words, a penalty, because you said to me that I can keep the money until 65. Now here you are, you're 50 years old, and you change your mind. Now I have to cancel that annuity, which is very expensive, because I have invested that money, because you told me that I didn't need the money until age 65. So because I have to cancel that investment now, I'm going to lose money. Okay, but the opportunity is lost. Okay, and so therefore I'm going to charge you a penalty. Now that penalty, of course, will be less and less and less as the years go on. So remember that deferred sales charge chart that we showed you earlier. It has a very similar type of thing, okay, where we will charge you a deferred sales charge. Or another way that they could do it is they will not give you as much interest. So for example, if I said to you that if you left your money with me until age 65, I'm going to give you 10% return of your money. However, at age 50, you changed your mind. Now I can't obviously give you 10% because I could only give you 10 if you allowed me to keep the money to age 65. But now because you came in earlier, I'm only going to give you 5%, 6%, whatever, that kind of stuff there. So that's what they call an interest rate adjustment. So the market value adjustment could be a deferred sales charge. It could also be an interest rate adjustment, basically. So in other words, the moral of the story, okay, is that if you buy a deferred annuity and you change your mind, there will be penalties. And that penalty is called a market value adjustment, okay? And that's essentially it. Now, bear in mind, okay, that once the payout starts, in other words, right here, the payout starts, you cannot take out, you cannot cancel it. It's fixed for that period of time. So that's why in an immediate annuity, there is no charges because the income starts right away. So once we start paying you out, you cannot cancel the contract. So in a deferred annuity, as long as it's accumulating, yes, you can cancel the contract, pay your penalties and all that. But once we start making a payment to you from 65 onwards, we start sending you a check, you cannot cancel the contract anymore. Okay, so at that point, it is rigid. It's very, very rigid, and you're not going to be able to cancel it. So you have to factor that in to your decision making in terms of your investments and everything else. Okay? So let's move on. So as I said, there's different kinds of annuities. Okay, so the first thing we'll look at is what we call a term certain annuity. And so as a term certain annuity, in this example, what you've got is a 20-year term certain annuity. So the client has basically said, look, here's my money. I'm going to deposit all this money. And what I want you to do is that I want you to give me an income for the next 20 years. So that is a term certain, in that it is term, in that at the end of 20 years, it's finished. There's no more money. So this is not a lifetime annuity. It is an annuity for a very specific period of time. And so therefore, you live for 20 years, you get all that money, and the very next day after your 20th birthday, that's it. The check stops. It's really as simple as that. Okay? If you die in between all that, somewhere along that continuum, you die, then the beneficiary could be paid either in installments, in other words, continue on getting the same monthly payment that you were accustomed to, or you may get a lump sum. It all depends, once again, on how you set up the annuity. So some companies will say, we'll continue on the same payments that you were getting until for the balance of 20 years, let's say, or we'll just simply commute the future payments and we'll give you one big check, and that's it. Okay, and so that's basically something that could happen. Now, on a term certain annuity, you may surrender for its commuted value. Okay, in other words, you could change your mind once the income starts and everything else. But once again, the penalties are very, very high. So we certainly do not recommend that you do that. The reason why they can do that, you see, is because it is a term certain. In other words, it's for a fixed period of time. You're going to see one in a moment where it goes on forever, in which case then you can never commute it. Okay, you just simply cannot do it. It's designed to give you an income for the rest of your life. So a term certain annuity is an annuity that pays out for a specific period of time. And should you die in between that, then your beneficiary will receive a lump sum or will continue to get the same payment as if you were still alive, basically, for the balance of the annuity period. So it is term that it expires, but it is also certain in that one way or the other, either you live and get all your money or you die and your beneficiary gets the balance of the money, the annuity will pay out. That's the main thing about a term certain annuity. Straight life annuity, this is the exact opposite. So in the term certain annuity, it is quite possible that you could outlive that 20 years. And therefore, then at the end of that period of time, you run out of money. Simple as that. Okay, you run out of money. And so what if you said, no, I want to buy an annuity that's going to give me an income for the rest of my life. Okay, the rest of my life. Now here, you do have a number of options that you could have. So once again, you give us your money, deposit, so all that stuff there, and we start giving you an annuity for the rest of your life. However, because it is a straight life, in other words, there is no beneficiary in a straight life annuity, the moment you die, the payments stop. Simple as that, okay? So the payments stop. There is no commuted value. There is no cash value. There is no beneficiary, nothing. So this straight life annuity gives you the maximum amount of money while you are alive. So for an individual who says, well, I don't have anybody. I don't have anybody to leave my money to, or my family is well taken care of. My spouse is well taken care of. My kids are well taken care of. I want the maximum amount of money while I'm alive so I can enjoy my money. And a straight life annuity is for that. Just all you have to remember to make sure the client realizes that once payments start, if he dies, all money stops. There is no other benefit at all. However, as I said, the options guarantee. You can turn around and you can buy some riders attached with it. In other words, guaranteed terms, guaranteed capital, get a cash refund installment. However, as I said, only those are available while the money is still sitting in the pot. But once your money starts getting paid out, there'll be no surrender possible if payments have started. So as long as money is still sitting in the pot, yes, you get cash out and all that sort of stuff there. As I said earlier, you're going to get market value adjustments and everything. But once we start making the payments, you can't cash out. The payments are the payments. That's the end of it, okay? You can also buy what's called an impaired annuity. So this is an annuity for an individual who's in poor health. So their life expectancy is much, much less, far less, let's say, than the normal statistical mortality. So therefore, as an impaired annuity, they're going to get a higher income. So normally your statistical mortality, let's say you be dead by age 80, that because you've got cancer or because you've got heart issues or whatever it is, your statistical mortality now age 65, let's say, and you're only 40, basically you're going to get a higher amount because you're impaired. You're going to get a higher amount than if you were not impaired. Because not impaired, you would have lived longer, so we have to make money last for a longer period of time. but because you are impaired, therefore we could actually pay you more. And that's why it says a person in poor health may be better served with impaired annuity. And impaired annuities pay a higher income than standard annuities based on the evidence that the annuitant has worse than average life expectancy. That's the key, okay? In other words, you're not going to live as long as you normally a similar person at your age, so therefore we're going to pay you more while you're still alive. But once again, once you die, it's finished. Okay, it's finished. There is no other residual benefit to this at all. Okay? Joint last survivor annuity are very, very popular. Okay, very popular. So in this case here, the annuity pays on a joint basis. So there's two lives. So husband and wife, let's say, whatever. Okay, the income will be paid out as long as either annuitant is alive. Upon the second death, the income stream will cease. So usually the income payments are reduced by 30 to 40% when the first annuity dies. So in other words, what happens here is, once again, you got this pot of money, and just because you got the money, yes, you can cash out just like you did before. But once you start making payments, you cannot cash out. So what happens here is that when the first annuitant dies, the future payments will be reduced to the second annuitant, anywhere between 30 to 40%. So if I was getting $50,000 a year while my wife and I were both alive, let's say, when I die, and my wife will then, because it is joint last survivor, she will continue to get income as well, but her amount will be less. It could be, let's say, $40,000 for the rest of her life. Okay, so for the rest of her life, she will get that. Okay, so life annuities are exactly that, life annuities. They pay out for the rest of their lives. Okay? So joint last to die with survivor benefit basically says is that two people are under their contract. The first person dies, the second person continues on getting an income. Yes, it will be lesser, but still it will pay for the rest of your life. Okay? So obviously, because it's joint last survivor, the payments will be less than a straight life annuity. See, in a straight life annuity, we only had one life to worry about. And so for the same $500,000 deposit, you're going to get a lot more money. But if we only had $500,000 deposit, in other words, same price, but now we've got two lives, and it's my wife and myself, let's say, that obviously now when one dies, the other one will continue on getting an income. So obviously the amount of money that we're going to get will be less than we would get on a straight life annuity because it's more expensive, obviously. So that makes sense. That makes sense. Okay. And once again, with annuities, you can buy registered and non-registered annuities. Okay. As I said before, if the annuity is a registered annuity, so the money that's growing, the pot that's growing, will be not taxed until the money comes out. Okay, until the money comes out. So therefore, the green part, like I say, is taxable amount. The dark green part is non-taxable amount. So your RSPs, for example, are registered annuities. So RSPs, RIPs, LIRAs, LIPs, or anything that's registered will be not taxed while it's in the pot, basically, but it will be 100% taxed when the money comes out at the other end. So always remember that registered money, the ACB is zero. So on registered money, whenever you take out any money, however it comes out, whether it be a cash or whether it be an annuity or whatever, it's 100% taxed. Okay. Non-registered annuity, okay, the money that you deposit, of course, will be not taxed, obviously, but only the interest will be taxed. Only the interest will be taxed. So in non-registered annuity, when you get the money coming out, the only portion that you will have to pay tax is on the interest only, not the capital. Whereas in a registered annuity, you're going to pay tax on all of it. Okay, all of it. In a non-registered annuity, what you're doing is you're only going to pay tax on the interest component, but not on the principal, because the principal is basically a return of your own money. So you must know the difference between registered and non-registered annuities. Okay. So what about risk? Do we have any risk? As I said, there's always risk of some sort. But in this case here, because it's an annuity, the risks are actually quite manageable. There is, of course, because an annuity is a fixed income security. So there is, if you remember, for fixed income, there is interest rate risk and there's inflation risk. there's also the risk of loss of capital. Remember that straight life annuity. You gave me your $500,000 and I started paying you $2,000 a month for the rest of your life. And then you died on me 6 months from now, you died on me. I keep all the money. In other words, I've lost the capital. So therefore, in a straight life annuity, you risk losing all your money. So you got to be very careful with that kind of thing there. Yes, you get the maximum amount of money while you're alive, but there's a price to be paid. And that price is that the moment you die, money stops. It's as simple as that. Okay. And so therefore, there's interest rate risk, inflation risk, and loss of capital for a straight life annuity. The recommendation of the contract, like I said, you can buy non-registered, and of course you can buy a registered annuities depending on what your needs are and everything. Okay. So let's take a look at the individual RRSPs. Okay, this is very, very important. You will definitely get a question on the exam on your RRSP. So the first thing we have to look at is how much RRSP contribution room do we actually have? In other words, the calculation. And the formula is always, as you see on the left side of your screen there, is 18% of the previous year's eligible income. Okay, of the previous year, okay, up to a maximum of, and again, depending on the, like in 2016, the maximum of $24,900. In other words, you cannot put any more than $24,900. So that's your maximum amount of money that you put in. So basically, it's 18% of your previous year's eligible income. Notice it's previous years. So if we're going to use 2016, for example, as the year, then you use 2015, 18% of your 2015 income, no more than 24,000 for 2016. Okay, and so therefore you're always 1 year behind. So on the exam, they may give you 2 years income, present, in other words, current year income and past year's income, previous year's income. Don't ever use current year. Always use past year, previous year. That's what we use. It's always previous year. Okay, and so therefore, so it's 18%. So now what happens is, so let's go over to actually before we go to 2016, let's assume the eligible income in the year 2015 is $15,000. And the pension adjustment in 2015 is $4,000. Pension adjustment is the amount of money, okay, the amount of money that that your employer or you have put into your RPP. So in other words, if your client has a company pension plan and the employer is putting in money and your client is also putting in money into that pension plan, you must deduct that from your RRSP contribution, and you'll see that in a moment. So it's minus your PA. Okay. Also, $12,000. So also your PSPA, past service pension adjustment. So in this case, it's $3,000. It's a past service pension adjustment. Okay? So basically, your PA pension adjustment is negative, in other words, minus, and your past service pension adjustment is also minus. So let's go through an actual example. So if you look at on the right side of your screen, you'll see that for 2016, let's say in 2016, you had an income of $15,000. That was your income. So 18% of $15,000 is $9,000. So you can put in $9,000. So if you did not have any kind of a pension plan, then you can simply contribute $9,000. But if you did have a pension plan, in other words, you did have an RPP, and you did contribute to that RPP, then you need to deduct that, the PA. So if you remember, in our example, yes, you're $9,000, but you also have $4,000 of pension adjustment. So really, you cannot deposit $9,000. You can only deposit $5,000. That's all you can deposit, because the PA reduces your RRSP contribution. Then, so you got $5,000. Let's say that you have carry forward of $12,000. Now, what the carry forward is, this is what they call unused RRSP contribution room. So from the day you started working at age 18, let's say, you have been accumulating room, RRSP room, but you've never used it. So now here we are in 2016, and you now have a chunk of dough, and you would like to catch up with all those payments that you should have made years ago, but you didn't do it because you didn't have the money. And so you can catch up. So carry forward basically is catching up on all past contributions. So you don't lose the carry forward. It just keeps on multiplying year after year. So therefore, it's a plus. If you notice, it's a plus. So the carry forward is 12,000. So it's $5,000 plus your 12 is $17,000. Okay. However, your employer also put in a past service pension adjustment on your pension plan. In other words, your employer threw in $3,000 in past service pension adjustment. That is a minus as well. And so your total amount of money you now can put into your pension plan, into your RSP, in this example, is $14,000. So moral of the story basically is you multiply 18% times your income minus your pension adjustment plus any carry forward that you may have minus past service pension adjustment. That's essentially what you're doing. So it's a fairly straightforward calculation. 18% of your earnings minus your pension adjustment plus your carry forward that you may want to use minus your past service pension adjustment. That is the amount of money that you can put in for the year 2016 in this particular example. Okay, so you will definitely get a question on the exam on that particular slide. Okay, so it is crucially important that you understand how all that works. Okay, let's move on. So at the end of the day, okay, if you wish to take out any monies from your RSP, okay, any monies from, in other words, you don't want to wait till age 65. You need some money before that. But the things you have to remember is that there will be what's called withholding tax. So up to $5,000, you can take 10%. You'll have to, the insurance company will withhold 10% of your money. So on your $5,000, you're only going to get $4,500. The other $500 is going to be sent to Ottawa for your taxes. Okay. If you take out between $5,001 to $15,000, it's a 20% penalty. $15,000 and up, it's a 30% penalty. So this is what we call the withholding tax. So if you take out any RRSP money, there will be a withholding tax. Okay, so you've got a pot of money, and you say, I need some money now. You're going to get penalized according to the amount of money that you're taking out. If you have over-contributed, then you will get a penalty of 1% per month for anything above $2,000. In other words, you do have $2,000 of contribution for life, your lifetime over-contribution for life. So if you put any more, so in that example that we have before, I just want to go back for a moment, that $14,000, you could actually put in $16,000 and be okay. But let's say you put in $17,000. That extra $1,000 is above the maximum contribution level, you will get penalized. So you got to be very careful that you don't go over the line. The penalties are quite stiff, basically. Okay. So in your RRSP, you must take out, the RRSP must be annuitized. In other words, it must mature no later than the year you turn 71. Okay. You can take it out anytime before that. You can mature it anytime before that. All I'm saying is that you must take it out by December 31st. You must annuitize it, in other words, mature it by a RIF, basically an individual registered retirement income fund, no later than December 31st of the year that you turn age 71. You could be 65 and do this as well, but you cannot be later than 71. So what you do is you could, let's go back. Sorry. Push the wrong button here, my apologies. So your RSP, you can buy a RIF. So at age 71, it starts giving you an income for the rest of your life, basically. You can buy an annuity, okay, that gives you an income for the rest of your life. Or you can simply take the whole thing, lump sum, cash it, but you're going to have to pay tax, considerable amount of tax on it, because it's all taxed, basically. So the last thing you want to do is take a lump sum. What you want to do is take it out as a RIF, take it out as an annuity, because by doing that, you only pay tax as you receive the money. Whereas if you cash it in completely, in other words, you got your $500,000 and you cash it in, pretty well half of it's gone in a lump sum. Whereas in a RIP, an annuity, buy an annuity, you don't pay tax on the entire $500,000. You're only going to pay tax on the money as received. So we don't recommend obviously a lump sum, but again, that's up to you what you want to do and everything. Okay, so let's take a look at another very important aspect. Okay, and again, you're going to get a question on the exam on this as well. So these things are very, very important. So you want to split income. The reason why we do any kind of splitting of income is to reduce the total tax income payable. So if you and your spouse, and you are in the higher tax bracket, and your spouse is in the lower tax bracket, you may want to move some of your money from your high tax bracket to somebody in the lower tax bracket, so that way you minimize your taxes, basically. So the idea of splitting income is to reduce your total income tax. The second thing you want to make sure of in making sure you're splitting income is to minimize the possibility of OAS, old age security clawback. Remember that once you reach a certain threshold, I believe this year it's around $74,000. For every dollar that you earn over $74,000, the government of Canada will tax you, will withdraw basically, or charge you 15% for every dollar above the $74,000. So what you want to do is you want to keep your income at below $74,000. So therefore, if you split income between your spouse and yourself, you still may get, let's say, $120,000, $130,000 in the family, but you're not getting it by yourself. You're splitting that with your spouse, basically. And so therefore, both incomes are below that $74,000, so you avoid the OAS clawback. Okay, so that's the other reason why we want to do a spousal RSP or splitting of income. So first of all, the contribution, the amount of money you can put into your spouse's RSP depends on your tax bracket. In other words, your contributions. So remember that $14,000 that we were talking about in our example. You can take that entire $14,000 and put it into your own RSP, or you can take the entire $14,000, put it into your spousal RSP, or you can take 50-50. Okay, whatever, whichever way you want. The entire deduction is based on the contributor, you being the contributor. Okay, so it's not your spouse's tax bracket or anything. It is your contribution, basically. So it's your money that you're putting into it. It is subject to attribution, which we'll talk about in a second. Okay? Withdrawals in the year of deposit or 2 calendar years amount withdrawn will be taxed to the contributor. This is very, very important. So in the example I'm giving you here is that I contribute, I say, to my spouse's RSP, spousal RSP in 2013, 10,000, 2014, 10,000, 2015, 10,000, and 2016, 10,000. So the question is, if my wife decided to cancel the RSP, in other words, she just canceled it, how much of that money will be taxed in my hands, and how much money will be taxed in the hands of my wife? Okay? So go back to the thing that it says there, withdrawals in the year of deposit or 2 calendar years, in other words, the last 3 years. Okay, the amount withdrawn will be taxed in the hands of the contributor. So therefore, the money that was in 2014, 2015, and 2016, in other words, $30,000, will be taxed in my hands, and the other 10,000, which was outside of the 3 years, will be taxed in my wife's hands. So that's what we're talking about, that there is attribution rules. So any amounts of money you put into your spousal RSP, and your spouse then withdraws that money in the same year or within 2 years of that, in other words, a total of 3 years, that money, even though your wife or your spouse will get the check, you'll get the money, but you're going to get the tax bill. Okay, it's going to be attributable back to you. So you will definitely get a question on the exam on spousal RSP. And more importantly, is what happens if the spouse collapses the RSP and there's money in there that's been deposited in the last 3 years. Who pays the tax? The contributor pays the tax, basically. Any amounts of money that are outside the 3 years, the owner of the spousal RSP will pay the tax on that. So there is that attribution room issue within 3 years, basically. That's the thing that you have to remember. So at the end of the day, like I said, you can buy an RRSP or you can buy a RIF. Okay. So if you have your money in a RIF, in an RSP, or if you have your money in a RIF, at the end by age 71, okay, no later than age 71, you must convert your money into a RIF, okay, a payout annuity. So a RIF can be bought at any age. You don't have to be 71. You can be 65, you can be 55. That's not the issue. Okay? The real issue is the fact that you cannot buy a RIF after you turn age 71. So you must do it by the year that you turn age 71. Okay? So there is also a minimum withdrawal to be made from the fund every year. Okay, and so therefore, again, Ottawa has a table. Okay, there is an actual table, and that table is payment is based on the age of the annuitant or the spouse's annuitant, depending on who bought the annuity, obviously. Okay, and so therefore, there is a minimum amount that must be taken out. So, for example, at age 71, you must take out 5.28% of the total amount of money that's sitting in your RSP, divided by 12, and that'll be that year's income, minimum amount. You can take out more. You do not have to turn around and stick to the basic. Okay? You can take out whatever amounts you want. Okay. All I'm saying is you cannot say, no, I don't want the money. You must take money out no later than age 71. So how they come up with this formula, that 5.28 basically, as to say percentage of withdrawal, the minimum, okay, is basically 1 divided by 90 minus the age times the market value. So for example, if you were 70 years old, and that's between 70 and 90, that's 20 years, right? So you must take out 1/20th. Okay, so 20 into 100 is 5%. You must take out 5% of the market value. So if you have $500,000 in your RSP, and the formula throws up that you must take out 5%. So it's 5% of $500,000, $25,000 basically, divided by 12. That's what you have to take out for that particular year, you see. So that's how they come up with the formula, basically. So it's 1 divided by 90 minus the age times the market value at the beginning of every year. Okay? Or you simply go to the CRA tables, which are provided by, so every insurance company, bank, anybody that issues RIFs has the table. So it doesn't matter which company you go to, the numbers are always the same because these are issued by Ottawa, so it applies to all financial institutions, basically. Okay. There is what's called qualified RIFs, in other words, RIFs that are purchased prior to 1992, and non-qualified, which are basically prior to, after 1992. And the difference really between one and the other is that between age 72 and 78, the percentages are slightly different. At age 78, it doesn't really matter. Okay, so quite honestly, I would ignore that altogether because today it really doesn't apply all that much. Okay, but the point is, you may run into a situation where it is a qualified and a non-qualified, and so basically, a qualified is anything bought prior to 1992, and anything that's non-qualified is any RIF that's bought after 1992. But like I said, when the person reaches age 78, it doesn't really matter because the percentages are going to be the exact same thing. So that's it. Okay. So as I said, there is a minimum that you must take out from your RIF, but there is no maximum. Okay, there is no maximum. So therefore, it can be closed anytime. You can cash it in anytime you want. So unlike an annuity, life annuity, where once the payments stop, you can't do anything with it. The RIF is very, very flexible, and that's why these are very popular because you can stop and go. You can take out the minimum, you can take out the maximum, whatever it is that you want. You can take the entire thing if you want and just cash it out anytime you want. Whereas in an annuity, once I've said to you, I'm going to give you, let's say, $5,000 a month for the rest of your life, you come back to me 10 years from now and you say, I'd like to cash out. You can't do it. It's $5,000 a month for the rest of your life. So an annuity, is very, very rigid. You cannot do anything with it. Once the payments start, you cannot change anything. In a RIF situation, because it's not a life annuity, it's very, very flexible. So that's why I said you can take out the minimum only, if that's all you need. And then next year you say I need minimum plus another 5%, another 10%. So the flexibility is there, basically for a RIF. That's why RIFs are very, very popular. So you must know this. So let's take a look at the individual savings plans when it comes to proceeds of debt. Okay? In other words, what happens if a person has an RSP or has a RIF? Okay? Because remember that a RIF is basically a continuation of the RSP. So all the rights and privileges that you have in your RSP is simply extended to your RIF. So there isn't a big difference in terms of rights and privileges. Obviously, an RSP is a deposit account and a RIF is a payout account. But like say in terms of where you can invest your money, the flexibility, all that is essentially the same. Okay. So at the time of death, the fair market value is included in the deceased income of the year. Okay. In other words, when a person dies and they have an RSP or a RIF, that the fair market value of whatever amounts of money is left in these planned funds is considered income in the year of death, and you're going to have to pay tax. However, there are exceptions to this. If the beneficiary is a spouse or common law partner, then the amount in the RSP or the RIF can be transferred to the spouse's RSP or RIF and taxed upon her death, or used to buy an annuity for the spouse. In other words, if you're married, either in legal marriage or in a common law marriage, I die, let's say, and my wife is my legal marriage, my spouse, okay, I die, the money can be rolled over to my wife without having to incur any tax liability whatsoever. Okay, so therefore, the money is protected against taxation because it's what they call a spousal rollover. Okay. Second exception to the rule, if the beneficiary is a financially dependent child or grandchild, then an immediate term annuity may be purchased in the child's name, subject to the term finishing when the child turns age 18. The annuity payments will be taxed at the child's MTR, marginal tax rate. That's what MTR stands for, is marginal tax rate. In other words, if I have a child that's younger than 18, I'll leave my child as safe beneficiary. Okay, so whoever it is that receives the monies, the guardian, whoever it is, the trustees, the executors that receive the monies, will buy an annuity for my son or my daughter, let's say, to age 18, and they then will pay the tax as they receive money year by year by year. Okay, so therefore, rather than pay the tax in one lump sum, I can again defer the tax over a period of time. If the beneficiary is an infirm child or grandchild, then the proceeds can be transferred to the child's RSP or used to buy a life annuity for the infirm child. So if, for example, that child is mentally or physically disabled, then I die, so therefore, and they are the beneficiaries. Once again, because they have a disability, they can also buy an annuity. And so once again, the tax can be deferred and only paid as the income is received. So three exceptions to basically paying tax in a lump sum is spousal rollover to a child who's younger than 18, or rollover to a child that's older than age 18, but mentally or physically disabled. Those are three exceptions where the amount of money can be rolled over on a tax-free basis, and then tax will only be paid on money as received. Basically, that's all we are. That's all we're doing. Yeah. So, companies, of course, company pension plans also exist. Some of you may actually have, or maybe your parents, for example, may have a company pension plan, and that's what we're talking about here. There are two kinds of company pension plans, and we need to know both. The first one is a defined benefit pension plan, a DPPP, okay, defined benefit pension plan. So here, what happens is the employer throws in amount of money, whatever that money is, and that money could change, obviously, okay, and the employee throws in their money, and the employee's money is fixed. In other words, the employee says, no, I'm going to pay $500 every single year. That's fixed. It will be $500 all the time. The employer, on the other hand, could change his mind. It could be, okay, I'll match it, or I'll throw $1,000 or whatever. In other words, it could vary basically. So that money goes into a pool of money, which is professionally managed. Okay, professionally managed, and that money now will then be invested, and the benefit then will be paid out at the other end when the person retires. So the normal retirement age is 65. Okay, and so therefore you could get 1% of the plan, 1.5% of the plan, 2% of the plan. In other words, all depends on the kind of plan that you got. So how we establish, okay, all this will very much depend on how much money you get. The main thing to remember about a defined benefit pension plan is that the employee knows how much money they're going to get at age 65. And that's why we say you're going to get 1% of the earnings at age 65 for the rest of your life. You get 1.5%, 2%. In other words, on the exam, they're going to ask you a question that the client knows how much money they're going to have when they retire. So therefore, if they know what the pension plan is going to be at age 65, let's say, then the type of plan that they've got is a defined benefit pension plan. So here, the contributions to the plan are tax deductible for both the employer and the employee. The growth is tax sheltered because it is a pension plan. Okay, money invested is administered by professional managers. In other words, this is not a situation where just anybody manages. You have to be really, really good at what they do. Okay, and the benefit formula is a set formula. In other words, there is a formula in the actual document that stipulates how the employee will get their money out at the other end at age 65. Basically, okay, and so the end result is that the client knows, or the employee knows, how much money they're going to get at the other end. The opposite to defined benefit pension plan is a defined contribution pension plan. So sometimes they refer to it as a money purchase plan. So in a defined contribution pension plan, the client, the employee, whatever, does not know how much money they're going to have at the other end. So a defined benefit, they're going to say, yes, I know that when I retire, I'm going to get $3,000 a month, let's say, for the rest of my life. In a defined contribution pension plan, we do not know. So it depends on interest rates, the market, all that sort of stuff there. So at age 65, what will happen is the employee will have basically a bucket of money, and then they use that bucket of money to buy an annuity. So if that bucket is very small, then obviously the annuity is going to be very small. If the bucket is big, they're going to get a bigger amount, you see. Whereas the defined benefit, you can plan with this because you know you're going to get that $3,000, so you can plan around that. Defined contribution, you really can't do that because you don't know what you're going to get until, you might say, the 11th hour, basically. So here, the employer puts in a fixed amount and the employee puts in a fixed amount. So the employee self-paid, I'll put in $500 every year, or every month, whatever, okay? And the employer says, I'll match it, so it's fixed, okay? Or the employer could say, for every dollar you put in, I'm going to put in $5, so it's fixed, okay? Basically, once again, professionally managed, that's not a problem, okay? And once again, at the other end, okay, the amount of money is variable because it depends on the fund at retirement. Like I said, we don't know what the returns on the investments are, not guaranteed. So unlike defined benefit pension plan, where we have the guarantee that at age 65 you're going to get $3,000 a month, this one here, there's no guarantees, and that's the issue with the defined. So if on the exam they say to you that the client or the employee does not know how much money they're going to get at the other end, then they have bought a defined contribution pension plan. Okay, whereas if they do know, then it is defined benefit pension plan. So once again, contributions, just like before, are tax deductible, the employer and employee. The growth is tax sheltered. Money is as professionally managed. However, the problem is at the end, the benefit will depend upon the performance of the investment. In other words, there is no formula like we had in defined benefit pension plan. There was a formula where the amount of money could very clearly be calculated as to what the person is going to get. Here, it all depends on the performance of the investment. So as I said earlier, if there's a big bucket of money, you get a big amount. If it's a small bucket, you get a small bucket. That's and that's all there's to it. You see. So that's the issue that you run into. Now, at the other end, okay, when you're ready to take out the money, once again, just like your RSP, you have to do it no later than that when you reach 71. It's the same thing here. If you have a company pension plan, you can start at 65. Of course you could, but you can also leave it to age 71, but you cannot leave it beyond age 71. So here, as it says there, in the registered pension plan, the defined benefit pension plan, the investment risk depends on the employer. In other words, the employer is responsible to make sure that the money is there. Well, because you have a guarantee, right? At age 65, you will get $3,000 a month. Okay. In the defined contribution plans, there's no guarantee. So the investment risk is up to you as the employee. So if you have a big bucket of money, fine. If you have a small bucket, then it's a small bucket. That's as simple as that. Okay. In all cases, whether it is defined benefit or defined contribution, the money belongs to you after 2 years of participation. In other words, money must vest to the employee no later than the second year. Some companies will do the first year, sometimes will do immediate, but for the most part, under the Pension Act, you cannot have any longer than a 2-year vesting period. So after 2 years of working for the employer, both the employer and the employee contribution becomes vested, and the employee controls the right to both employer and employee contribution. In other words, the employer and the employee money belong now to the employee. So it vests to them. So both monies, the employer's contribution and the employee contribution, now vest to the employee. Okay? So the employer cannot take that money away from you. It is also portable. So if you lose your job, if the employee leaves the job, he may transfer the funds to another RPP, in other words, another employer that has an RPP. You can certainly transfer to your new employer that has an RPP, or you can buy, as it says there, a LIRA, locked-in retirement account, or as it's called, the locked-in RSP. So if you are younger than age 55 and you leave your employment and you cannot take your money with you because your new employer doesn't have an RPP, the only place that you can put your money in is a LIRA, like a locked-in retirement account. In other words, you cannot take the money and put the money into your pocket. This is locked in. That's why that L is very important. It's a locked-in plan. And so therefore, the money must stay in a LIRA up to age 55. At age 55, you can begin to take money out, and you'll see how that works in a moment. But you can also let it sit there. Okay, you can let it sit there all the way to age 71. So if you don't have to start an income, so if you don't need the money at age 55, you can just simply leave it there until the day that you do need the money, but up to age 71 is your absolute maximum. Or like I said, you can transfer that money into a new RPP with your employer. Okay, so basically, leave the funds accumulated in the same plan, and the benefits will be paid as per the rules of the plan. You can also, in other words, leave the money with your current employer. So you leave your employer, then you basically leave the money with your current employer, and that money will sit there, grow accordingly, and so on and so forth. And at the other end, then you get your pension plan from your current employer, even though you've left them. So basically, those are your options. But if you notice that in all cases here, you cannot cash this in. That's the key. You're not cashing it in. Whereas in an RRSP and a RIF, they were not locked in money. So if you decide to cash it in, you can cash in whenever you want. In these plans here, you can never cash them in. Okay, you can never cash them in. The monies are locked in because they're designed to give you a pension for the rest of your life. And what kind of a pension is on this page here. So on maturity, which cannot be any later than the year you turn 71, December 31st, the year you turn 71, okay, you can turn around and you can take your RPP money, like I said, you can go all the way. If you are over 55, you can buy a LIF, a light income locked-in fund. And that locked income fund will give you, has a minimum amount of money that you must take out, but it also has a maximum. If you remember with the RIF, I said there was minimum, but there were no maximum. In the LIF, there is a minimum and a maximum. But again, L is locked in money. Or the money could have gone into a lira, and then from the lira, it went into a LIF because you were over 55. Okay, so you can let it sit in a lira until you're age 71 or earlier and buy a LIF. Okay? Or depending on your province that you are in, you can buy an LRIF, locked in retirement income fund. I believe the LRIFs are not available in Ontario, but they are available in Newfoundland, Saskatchewan, and Manitoba. So you cannot buy an LRIF in Ontario or Quebec or BC or anything, but you can buy a LIF in any of the provinces. So all provinces offer a locked-in fund, and again, minimum and maximum. But only 3 provinces in Canada offer an LRIF, locked-in retirement income fund. So this works like a RIF, except the money again is locked in. And once again, there's a minimum and a maximum that you can take out. Or you can buy a life annuity, okay? Basically, and provide you with a pension for the rest of your life. That life annuity, once again, can come from a lira, or it comes directly from your RPP if you are 55 and over. Okay, like I said, up to age 55, it has to go into lira. So once it's in lira, you've got all these options here. Okay? But you can certainly start your RP if you are over 55. You can go all the way to a LIF if you want right away, or you can go into a life annuity right away. But you've got to be 55 and over. So basically, what we're saying is from 55 and over, you can have a lifetime income. Up to that point, it has to stay on deposit until you reach age 55 or beyond that. So what I want to draw your attention to is that when you're looking at company pension plan, the monies are in there, all locked in. Okay, so that's why that L is all locked in. So you can never cash these things in. They are designed to give you a lifetime income. So the other thing that an employer can provide for you, and more companies are providing this now. In fact, if I remember correctly, New Brunswick just introduced this in this year, I believe it was, that they've introduced it. So it's what they call an employer-provided a pension plan. Okay, so basically an RPP, but it's basically a pension that is available by your employer to make it available to you. So it's the newest pension plan, and it is in Quebec. It's called a voluntary retirement savings plan, and must be put into place if the employer does not have a pension plan and has at least 5 employees. A PRPP is similar to a defined contribution pension plan, except that the employer contributions are not compulsory. And the funds can be transferred to an RRSP, a RIF, or a DPSP. So basically a PRPP, you might say, is a voluntary pension plan, in that the employer can provide this pension plan for its employees that don't have a defined contribution, don't have a defined benefit pension plan. And the beauty of this is that the employer does not necessarily have to contribute, whereas in the other two, they did have to contribute. It's mandatory contribution. In a PRPP, it's really a pension plan that can be set up, and the employer does not have to put in a dime. It can all be done by the employees only. So it's designed basically essentially for small businesses to provide some kind of a pension plan for its employees, basically. Okay, that's really what it's designed. So it's a professional retirement pension plan, basically, is available now, I believe, in all provinces. New Brunswick being the latest one that just announced that the other day, actually. You can also provide a guaranteed, what they call a GRSSP, okay? In other words, a group RRSP. So you can buy an RRSP on an individual basis, but if your employer is prepared to make the deduction from your paycheck, basically, you can actually group it. Okay, you can actually group it. So it's the same as an RSP, except that it's offered on a group basis. The fees are going to be less because, again, the cost is spread out a lot among more people. So therefore, we can reduce the cost of putting these plans together. It may offer a limited investment choices. In other words, it gives you a choice of various places you can invest your money. The most important thing about a group RSP is that it's a payroll savings plan. In other words, your employer has agreed, that they will deduct, let's say, $500 paycheck. So therefore, if you don't see the money, you won't spend it. And so they can go into your RSP. Now, because it's an RSP, you can also buy HPP, which is a home buyer's plan or lifelong learning plan. So remember, with an RSP, two non-pension uses of RSP is home buyer's plan. In other words, you can borrow up to $25,000 from your RSP without incurring any taxes, as long as you use that money to buy a house. Okay, or you can have lifelong learning pension plan. You can borrow up to $20,000 from your RSP to pay your tuition fees. Once again, you must go full-time, or in some cases part-time as well, in a educational institution. So once again, even though it's a group RSP, you still have that privilege that you can borrow against the group RSP to buy yourself a house or get a proper education and everything else. Contributions are made by the employee, and the employer may also contribute. Don't have to, but they might. We usually recommend that the employer throw in some money because it obviously is an incentive, let's say, for the employee to actually make their contributions. The employee contributions are tax deductible. Okay, contributions to both the group RSP and individual RSP cannot exceed the individual's total RSP contribution room. In other words, even though it's a group RSP, you're still subject to the 18% rule that we talked about before. So 18%, of your $50,000 minus your PA, minus your SPA, plus your carry forward. Those rules still apply because it still is an individual RSP from that perspective, except that it's grouped under an employer, basically. So you can transfer that money out then at the end. You can transfer to your own RSP if you ever leave your employment, for example. Simply take that with you. There's no penalty or anything. Just simply take that money with you and that's it. Or you can transfer to your RIF. In other words, you want to have an income. Again, there's no penalty here. So really what it is, it's really a very, very convenient way of having employees save for retirement without all the strings attached of a defined contribution plan and defined benefit pension plan. Because like I said, with those plans, the money is locked in, not very, very flexible in that regards. You can also buy, of course, an annuity. So you can buy a life annuity, like I said, gives you an income for the rest of your life, Or if you want, which we do not recommend, cash it in, pay your taxes, and move on from there. Okay, so you can certainly cash it in because it is an RSP. So an RSP, unlike a defined contribution or defined pension plan, in other words, your company-sponsored pension plans, where there is no flexibility in these kind of situations, be it a PRPP or a group RSP, there's lots and lots of flexibility. And that's why employers in particularly gravitate towards these kind of plans more than the other ones. You can also buy group retirement investment. In other words, you can also buy segregated funds on a group basis. So we talked about segregated funds before, but because this is a group, there is a slight change in the rules. Okay, there is a slight change in the rules, and you need to know that. First of all, you have the same investment options as you had before, so that's not a problem. So with segregated funds, you can pick up any kind. You can have capital preservation, income growth, whatever it is that you want, just like we did before. However, some of the characteristics that you have to be careful about, there's no sales charge. Okay, there's no sales charge at all. So therefore, you don't have to worry about the first sales charge, upfront loads, and all that stuff there. There's also no switching fees. No switching fees. Remember before I said that if you switch from one fund to another, we may charge you a fee. The MERs, management expense ratios, are also lower because remember it's a group, right? So we can spread the cost over a much larger group of people versus just you as an individual. And there's no maturity and death benefit. And that's very important to remember. If you remember, we said that one of the main features of an IBIC, basically, or segregated fund, was the fact that you had the death benefit guarantee and you had the maturity guarantee. In a group segregated fund, there is no maturity guarantee and there is no death benefit guarantee. So that's something you have to be careful about when you're thinking about maybe putting on a group segregated funds, is that there is no maturity and death benefit guarantee. So that's important to you. Then you should buy an individual one, and that way you get that coverage. Okay. You can also buy group annuities. So at the other end, for example, you're 65. You can use your defined contribution money to buy a pension plan, basic for the rest of your life. Or if you're using your RSP money, your group RSP money, you can also buy a group annuity. So once again, your employer can arrange with the insurance company to issue group annuities, and once again, your fees will be lower. Your investment will be maybe a little bit higher because we've got a larger pool of employees basically putting all their money in. So therefore, get what's called an economy of scale. So it is not a bad idea to do it that way as well. Okay, so we are finished for the night. As always, if there are any questions, because I know this is a fairly complicated subject, and I know that there's a lot more than what I even showed you, but again, we have a limited amount of time. Remember that we do have all of this and more on the website for the videos and everything, so please make sure you review those as well. So once again, if you have any questions at all, please email me, and I'll be glad to answer them within 24 to 48 hours. Okay. I'm going to leave things on for now for a few more moments. If you have any questions, I'll be happy to answer them at this point.